Hey everyone, welcome back to Corporate Dakota, the place where we break down the confusing world of business filings to give you the real story behind the numbers. And today we're diving into ARVANA Inc.'s latest filing and amendment that shows they've had to go back and fix some numbers from their last report, talk about a do-over. Before we get into the nitty-gritty, if you're tired of corporate jargon and want to know what's really going on with companies, make sure to hit that subscribe button. And if you want to join a community of like-minded finance enthusiasts, check out our Discord server linked in the description below this report. Is a bit of a mess, a restatement of financials, and a big old admission that things weren't reported quite right last time. Let's see what they're trying to clean up. So this is an amendment to their quarterly report. And the big news is right at the top, they're restating their financial statements from a previous report. This usually means they found some errors and need to correct earnings, revenue, or other key figures. They're admitting that the previous report had issues and they had to go back and fix them. Specifically, it says the restatement corrects errors related to capitalizing website development costs, the way they booked professional fees, and how they handled stock-based compensation. Let's start with their balance sheet, which is like a snapshot of what the company owns and owes at a specific time for June 30, 2024. They had total assets of $21,19,795, but a huge chunk of their liabilities were over $1.3 million. That means they owed a lot more than they owned, which is never a good sign. Looking at their liabilities, accounts payable was a massive 22591 on June 30, 2024. That's a big number, but it's actually way down from 10849 at the end of the previous year. A good sign they're paying off their short-term debts. Now listen to this, they owe 405 on AVOT Chef Ad T1 in related party payables. This means they owe money to people or companies connected to them, like executives or major shareholders. This can sometimes be a sign of financial strain where a company is relying on insiders to keep afloat. Their current portion of notes payable was only 167.1 on June 30, 2024. That sounds low, but last year it was almost 80,000. So they've clearly been paying down their short-term debts, which is positive. But here's where things get interesting. They have over $1.1 million in related party notes payable that aren't due right away. This is long-term debt owed to insiders, and it's a huge amount compared to the company's overall financial picture. Now let's look at their income statement. The report shows their revenue and their expenses to see if they're making money. For the 6 months ending June 30, 2024, their total revenue was only $373, so it's incredibly low for a public company. Interestingly, a good chunk of that revenue, $24,000, was from leasing out their marine equipment. This suggests their core charter business isn't bringing in much, and they're relying on renting out their assets. Their cost of services was $18,390 for the same period, meaning it cost them a lot to provide those charter services, making their profit margin very thin. Their operating expenses were a whopping $26,005 for the 6 months ending June 30, 2024. That's over 7 times their total revenue. This is a massive red flag and shows how much they're spending just to keep the lights on. And the result of all this is a net loss of $227,360 for the 6 months ending June 36 for the 6 months ending June 30, 24. This means they're consistently losing money, and the situation actually got worse compared to the same period last year where they lost $11,402,269. This section shows their equity, or how much the owner's stake is worth, and it's not pretty. They have a total stockholders deficit of over $1 million, showing that their liabilities outweigh their assets. The accumulated deficit is a staggering $3,786,86892. This is the total amount of money the company has lost since it started operations. It's a massive hole they're trying to climb out of. It's also worth noting they had to restate numbers from previous periods as well. For instance, the 3 months ending June 30, 2024 showed a deficit of over $1.1 million before the restatement, and the 6-month period showed a deficit of over $1.1 million too. Looking at cash flow, which is super important for day-to-day operations, they used $20,749 cash for operations in the first 6 months of 2024. This means their core business is burning cash, not generating it, and it's worse than the previous year's outflow of $992.90. They also spent $25,000 on investing activities, which was for website development. This shows they are spending money on their future, but it's a small amount given their overall financial situation. On the financing side, they brought in 2254,110 from financing activities. This was mainly from those related party loans. We talked about showing they're relying on insiders to fund their operations. This entire section is about the errors they found and corrected. They admit to issues with capitalizing website costs, professional fees, and stock-based compensation. It's a clear sign of weak internal controls. One specific correction was about capitalizing $25,000 in website development costs and then amortizing it. Amortizing means spreading the cost over time as the asset is used. This is a standard accounting practice, but it highlights the initial error in how they handled this. They also had to adjust their accounts payable by nearly $50,000, which was due to wrong accruals for professional fees and other expenses. This again points to accounting errors. Their related party payables also went up by over $45,000, which included corrections to accrued interest on those insider loans and amounts owed to parties that became related more recently. This is a big one. They reclassified $35,000 from their current liabilities to long-term liabilities for related party notes payable because they agreed to extend the repayment dates. This means they've rolled over their debt, pushing it further into the future, which can be a sign they can't pay it back on time. They also adjusted their additional paid-in capital by about $41,000, which is related to those stock-based compensation corrections. Ultimately, all these corrections led to a slightly larger net loss for the period. They're admitting their earlier reports understated how much money they were actually losing. In their management discussion, they talk about seeking business opportunities in real estate development while still operating this fishing charter business. They announced a deal to acquire a company that repurposes vacant malls, but that deal fell through. They're now looking at other ways to pursue that model. Their plan of operation is pretty much to try and make the fishing business more profitable by expanding marketing and maybe getting a bigger boat, but they admit capital is their main hurdle. They need money to buy new equipment. They essentially expect things to get more expensive with higher accounting and auditing fees as they try to improve their financial reporting. They admit their disclosure controls and procedures were not effective due to material weaknesses in internal controls. They specifically blame the capitalization of website development costs, accrual of professional fees, and stock-based compensation. This is a big admission of failure in their accounting and reporting processes. The CEO, James Kim, and the CFO, Andrew Morrison, both certified the report, but they also admitted to material weaknesses in internal controls, which is a big deal for investor confidence. Now, for my take on ARVANA Inc. based on this report, when you look at the numbers, it's hard to be optimistic. Their revenue is minuscule, their expenses are massive, and they're losing money hand over fist. The reliance on related party debt is concerning, as it suggests they can't get funding from traditional sources. The fact that they had to restate financials twice in this report is a major red flag. It shows either a lack of competence in their accounting department or a serious issue with their internal controls. Frankly, it's a bit of both. Their plan to expand into real estate development seems stalled, and their core fishing business is barely bringing in enough revenue to cover its own costs. The need for external funding to grow is clear, but with such a weak financial position and leadership that's admitting to major accounting errors, attracting that funding will be incredibly difficult. The company is essentially burning through cash with very little to show for it except a growing mountain of debt and a significant accumulated deficit. It's hard to see a clear path to profitability based on these figures. What's your take on ARVANA Inc.'s situation? Do you think they can turn things around, or are they in too deep? Let me know in the comments below. If you found this breakdown helpful, hit that like button and subscribe for more in-depth corporate analysis. Thanks for watching, and we'll see you in the next video.